Jaltech's tax-deductible solar investment, giving investors exposure to an asset class that provides predictable, long-term yields and a tax benefit available to South African taxpayers. This investment takes advantage of Section 12B of the Income Tax Act, which says, where a taxpayer purchases solar equipment for the purpose of generating income from the sale of electricity, the taxpayer is entitled to claim a tax deduction based on the amount invested. The tax deduction isn't limited to 100% of the investment value, but to 125% of the investment value. And the tax deduction is available to individual taxpayers, companies, and trusts. To explain the tax deduction, if you have a look at the middle column, we have an investor who earns 5 million rand a year. This investor doesn't invest in a Section 12B investment. As a result, their taxable income remains the same and they pay around 2 million rand in tax. The same taxpayer in the far right-hand column earns 5 million rand a year and decides to invest 1 million rand into Jaltech's S12B investment. As a result, because the tax deductibility is 125%, the taxpayer can reduce their taxable income by 1.25 million rand, resulting in the taxpayer's taxable income reducing, the tax payable reducing, and ultimately a saving of 562,500 rand. In order to provide Jaltech's investors with the Section 12B benefits, investors invest into a partnership structure, similar to partnership structures that one would find in a private equity arrangement. The partnership pools investor capital and enters into relationships with solar operators. The solar operators bring customers to the partnership, and the partnership will do a credit analysis on the end customer. The end customers are typically property holding companies. Once the credit analysis has been completed and the end customer approved, the partnership will provide the solar operator with the necessary capital to buy the solar equipment on behalf of the partnership, to install, maintain, and operate the equipment on behalf of the partnership on the customer's premises. The partnership would conclude a power purchasing agreement with the end customer and bill the customer on an annual basis. Throughout the term of the arrangements with the end customer, the partnership will retain ownership of the equipment, thereby allowing investors to enjoy the Section 12B benefit. From a deployment perspective, we're only looking at commercial and industrial property owners. The reason being, it's easier for us to analyze their creditworthiness, and typically the check sizes in these arrangements are between 15 and 20 million rand. We're not at this stage considering the residential property market. In the second year of the investment, we're looking to raise debt funding within the partnership at a maximum of 34%. This carries a significant benefit for investors as illustrated in the table. You'll note that the investor invests 1 million rand and in year one receives the tax benefit or saving of 562,500 rand. As well as the tax benefit, we aim to return 135,000 rand to the investor. In the second year, we look to introduce debt funding, which allows the partnership to buy additional equipment. When the partnership acquires additional equipment, the investor is entitled to an additional refund because the investor owns additional equipment through the partnership. Because we're capping the debt at 34%, the investor receives an additional 289,000 rand tax benefit. In addition, the investor will receive cash inflows of around 131,000 rand. If you add the 2 refunds and the 2 cash inflows minus the tax the investor would have paid on the cash inflows, the investor would have received just over 1 million rand. As a result, the investor is completely de-risked from the investment at the end of the second year, because we're limiting the debt funding to 34%, we do not believe that the risk profile of this investment is materially affected. From a returns perspective, this table indicates the cash inflows and refunds received from SARS over the term of the investment. There are a few assumptions. The first is that the investor is in the highest tax brackets, the prime interest rate remains the same, and that we sell the solar asset at 20% of its original value at the end of the term. Finally, that we're able to raise debt funding at a maximum of 34%. If you look at the top of the table, in year 1, the investor receives a tax refund of 562,500 Rand, and they enjoy cash inflows of just above 135,000 Rand. In the second year, the investor receives an additional tax refund and thereafter enjoys annual cash flows from the investment. After year 2, the investor is completely de-risked and all income thereafter is profit in the investor's hand. In year 10, we assume that we sell the asset at a conservative valuation of 20% of its original value. If you add up all of the cash flows and the tax benefits, at the end of the term, the investor should have accumulated just over 2.5 million Rand. If you take off the tax and Jaltech's fees, the return is just above 1.5 million Rand. The final row demonstrates after tax, after fees, and with the tax benefits, the internal rate of return of the investment being 24%. An IRR of 24% may prompt questions of what type of risk the fund manager is taking to generate such high returns. As you will see on the following slide, the risk profile of this investment, in Jaltech's view, is low. The following factors materially reduce the risk profile of this investment. Firstly, the investor stands to receive a 100% return of their investment within 24 months. This is a result of the cash inflows and tax refunds. The investor receives annual cash flows, which further de-risk the investor, and the underlying investment is a physical asset. If a customer defaults, we can collect and redeploy the assets, and the assets are fully insured. Lastly, the credit risk of the end customer is known to Jaltech due to our in-depth due diligence, which helps us understand their energy consumption and whether they have been honoring their obligations to Eskom. Each of these risk mitigants further reduce the risk profile of this investment. As with any investment, there are risks. We've identified the 3 main risks associated with the Section 12B investments. The first risk is credit risk. This refers to the risk associated with the end customer who we provide equipment to. If they're not creditworthy, the investment will underperform. Jaltech is a fund manager who manages hundreds of millions of rands in funds which we invest in businesses where we need to have a clear understanding of the credit risk of the business. So we have many years of experience managing large pools of capital. The second risk is deployment risk, which is one of the major risks in this investment. If Jaltech fails to deploy the capital this financial year, our investors will not be able to claim the tax benefit. To mitigate this risk, we've capped our fund at 100 million Rand and have a pipeline of opportunities of over 150 million Rand to deploy the capital into. We're very confident that we can deploy the capital well before the end of the financial year. Lastly, debt funding risk. As with any investment where there is debt, there is an obligation to pay back the bank. If we fail to do so, due to the performance of the underlying business, the investment would be at risk. We mitigate this risk by capping the debt facility to a maximum of 34%, and we believe that this level of debt is not material in increasing the level of risk in the investment. Investors may be concerned about the long-term nature of the investment, being 10 years. and that ultimately you would have exposure to an investment in South Africa. However, in our view, this investment is actually a hedge against the decline in the South African economy for two reasons. The first is, if load shedding is persistent, our end customers are incentivized to honor their obligations in terms of paying the price at which we will be selling electricity to them. If load shedding ends, we're confident that the rate that we will be charging the end customer will be lower than the rate Eskom will be charging its customers, meaning that it would make sense for the end customer to buy electricity from us as we would be providing it at a cheaper rate. So, if South Africa continues to decline, we believe the investment will continue to perform. To summarize, our minimum investment is 250,000 Rand. This is a 10-year investment, and investors are exited through distributions and the tax benefits. The underlying investment is asset-backed and the assets are fully insured. The internal rate of return, net of fees and taxes, and including the tax benefits, is 24%. We aim to de-risk the investor to 100% after 24 months. There is a 100 million Rand cap on the fundraise, and for investors who are interested, they would need to complete a commitment form and make a deposit of 5% of their investment value. When we're ready to deploy the capital into an asset, we will call on the remainder of the investment value. To summarize, our minimum investment is 250,000.